So if you're getting into precious metals, there's always one big question that comes up, right? How do you split your portfolio between gold and silver? It's a classic dilemma, trying to balance the undisputed king of metals with its, more energetic younger sibling.
And you've probably heard this simple rule of thumb, something investor Sean Fu talks about a lot. 80% in gold, 20% in silver. It sounds simple, it sounds clean, but it makes you wonder.
Yeah, why that specific 80-20 split? What is actually going on under the hood that makes so many seasoned investors treat gold as the absolute core of their holdings, with silver playing a much smaller role? Let's dig into the actual data and see what it tells us.
Okay, so the answer really starts with understanding one key thing. This is not a partnership of equals. Not at all. Academic research shows a very clear hierarchy. There's a leader and there's a follower, and gold is the one calling the shots.
To really get this, we have to talk about something called the volatility spillover effect. It sounds complicated, but it's pretty simple. It just means that when one asset's price starts jumping all over the place, that choppiness can actually spill over and make another, related asset start acting erratically too.
And this is exactly what researchers found with gold and silver. It's a one-way street. When the gold market gets volatile, it directly causes the silver market to get volatile. But, and this is the critical part, it doesn't work the other way.
In fact, a really detailed study of the Shanghai Gold Exchange, which is a huge market for physical metals, nailed this down. When gold moves, it sends ripples that rock the silver market. But when the silver market gets choppy, gold just sails on, almost completely unaffected. The takeaway couldn't be clearer. Gold leads, silver follows, period.
So if silver is the follower, what does that actually look like? Well, in practice, it means silver is way more reactive, it's got a much higher beta, and as we're about to see, it carries a whole different level of risk.
And just look at this chart. The difference in risk is just wild. Using standard deviation, which is basically just a way to measure how much a price swings, the numbers are incredible. Gold's volatility score is around 37. Silver's, it's over 1,000. This isn't just a little bit more volatile. We're talking about a completely different animal.
And the research found something else that's really fascinating. They have totally different personalities when it comes to news. Gold tends to react more strongly to good news, but silver gets really spooked by bad news. Researchers call this an asymmetric response, and it explains so much about why silver feels more speculative. It just tends to overreact when things go sideways.
Okay, so we've established the what. Gold leads, silver follows, and is way more volatile. But now for the big question. Why? Well, the reasons are actually rooted in three key things: what we use them for, who holds them, and honestly just how we think about them.
These charts pretty much tell the whole story. Look at gold. Somewhere around 85% of all gold demand is purely for investment. We're talking bars, coins, and yes, even jewelry bought as a store of value. But for silver, that whole relationship is flipped on its head. About 2/3 of its demand comes from industry.
And the implication of that is massive. It means gold's price is driven by thousands of years of perception as money, as a true safe haven asset. Silver, on the other hand, is heavily tied to the health of the global economy. When factories are humming and we're building things, demand for silver goes up. When the economy slows down, so does silver demand.
And when we talk about gold's role as money, nothing makes the point clearer than this one staggering number. Central banks, the biggest financial institutions in the world, collectively hold over 35,000 metric tons of gold. That is the ultimate institutional stamp of approval.
And as Sean Fu points out, you don't see central banks stockpiling silver, do you? No. In a world where currencies are constantly being devalued, they are hoarding gold. They see it as real money. If there's ever a major global currency reset, what do you think they'll anchor the new system to? The asset they already own by the thousands of tons? And that's gold.
All right, so we've covered the academic research, we've covered the market fundamentals. Let's bring this all home and talk about what this actually means for you and how you can build a smarter strategy.
This table really just lays it all out, nice and simple. On every single key metric, gold and silver are fundamentally different players. Gold is the stable leader, driven by investment and backed by the most powerful banks in the world. Silver is the volatile follower, driven by industry and pretty much ignored by those same banks. They might both be precious, but they play totally different games.
So what's the bottom line for your portfolio? I think the best way to picture it is this. Gold is your anchor. It's the heavy, stable, safe haven core that holds everything down. Silver? Well, silver is the kite. It's tied to the anchor, sure, but it's designed to soar or crash based on the shifting winds of the economy. That 80-20 rule we started with? It's a strategy built entirely on that anchor and kite reality.
Now it's true, for centuries, silver was incredibly important as money. It was the metal of the people, used for small, everyday purchases. But let's be honest, in today's world of digital payments and credit cards, that specific job for physical silver is pretty much a thing of the past.
And that brings us to the really big, forward-looking question. In a world that is now buzzing with digital currencies and crypto assets, all of them claiming to be the new money, can gold's 5,000-year reign as the ultimate store of value continue? Or will the king, finally, after all this time, lose its crown? Now that is the multi-trillion-dollar question.